In this video, I show you exactly what happens if you don't know which accounts an RMD affects. I also show you how to prepare so you don't get hit with a giant surprise charge. Coming up next on Holy Schmidt.
Holy Schmidt!
A required minimum distribution is one of the most controversial aspects of U.S. tax law. Why? Because it doesn't just affect your tax rate, it affects other things as well. Let's start off with the one that most people don't connect. Your required minimum distribution and your Medicare premium feel like two separate charges, and they shouldn't have anything to do with one another, but they do. Once you reach age 73, at least for most of the people watching this video, the IRS requires you to take a minimum amount of money out of your 401k or your IRA. That's called a required minimum distribution, and it's not optional because all sorts of bad things happen to you if you don't take out your RMD. Now, before we go any further, let me define 401k and IRA. I'm talking about the tax-deferred versions, not the Roth versions. Qualified Roth withdrawals generally don't count in the income that Medicare uses to calculate IRMAA. That's the surcharge. However, every dollar of that RMD counts as income, and income is used to determine if you're going to have a Medicare surcharge and how much. In fact, the specific calculation is modified adjusted gross income, and when you take out an RMD, 100% of that RMD goes toward modified adjusted gross income. Medicare calls that charge IRMAA, Income-Related Monthly Adjustment Amount. The higher your income, the more you pay on top of the standard premium, which in 2026 is $202.90 a month. Fair enough, some people might say, because if someone's making a lot of money, maybe it makes sense. But what doesn't make sense is that it's not based on this year's income, it's not based on last year's income, it's based on your modified adjusted gross income from 2 years ago. And a lot changes in 2 years for a lot of people, particularly in retirement. Picture this, you're age 73 and you're required to take a distribution from your IRA or your 401k. You don't like it, but those are the rules, and you have to pay a big tax payment on it because it's a large amount and you didn't need it. It pushed you into a different tax bracket, a higher tax bracket. But you write the check and you think you're done. You're not done, because that same income sets a higher Medicare premium 2 years after your required minimum distribution. Now, a lot of people find this counterintuitive. Why? Because who would connect a retirement account withdrawal, a forced retirement account withdrawal, with health insurance? They shouldn't be linked. Unfortunately, they are. But the good news is that if you know the issue, you can manage the issue. There are solutions to this. Let's talk about the numbers for 2026. If this isn't an RMD year for you yet, that's a good thing. It means you have time to plan. But let me illustrate what the issue is. The standard Part B premium in 2026 is $202.90 a month. Most people pay that. The IRMAA surcharge starts once your modified adjusted gross income passes $109,000 if you file single, or $218,000 if you file jointly. Remember, that's based on your 2024 income. At the first tier, the surcharge adds $81.20 a month to Part B and $14.50 a month to Part D. That's $1,148 a year per person. For a couple where both are on Medicare, then you need to double that number. It climbs up from there. At the top tier, the Part B premium reaches $689.90 a month. Compare that to $202.90 and you can see the massive spread. It's over three times the original cost of Medicare Part B. Now, the part that stings is that Medicare is a cliff, not a slope. When you go $1 over the limit, you have to pay the full surcharge for that entire next bracket. It's not like taxes. If you go $1 over one tax bracket, you pay the additional tax on that $1. It doesn't work that way here. You get 100% of the bracket if you go $1 over. In other words, $1 of income can cost you over $1,000 a year per person. Now let me put real money on this, and we'll use a big number just to illustrate this. Let's say that you have $2.5 million in your IRA. Your required minimum distribution that year is roughly $94,000 using the IRS Uniform Lifetime Table. Add Social Security and any pension, and a couple can clear $218,000 pretty quickly. And you go up one tier or two tiers, maybe even three, depending on how much over the threshold you are. And one other point that trips people up is modified adjusted gross income isn't just adjusted gross income. A lot of people plan to reduce their taxes, and so they have tax-free municipal bonds. But modified adjusted gross income includes the income from tax-free municipal bonds. And this is one of the big reasons why someone who manages their taxes in retirement gets caught off guard, because tax-free should mean tax-free. It doesn't mean surcharge-free. Now that's the size of the problem. Now let's talk about one situation that a lot of households face into, and it creates an IRMAA surcharge. It's called the widow's tax. It's an unfortunate situation, but it happens to a lot of people. And when someone has a required minimum distribution as a couple, they're in a higher tax bracket. But when one spouse passes, the survivor files as a single filer in the next year. And here's the problem. Oftentimes the income barely changes, but the bracket gets cut in half. Let me show you exactly what I'm talking about here. Imagine a couple that has a modified adjusted gross income of about $250,000. They sit in the first joint surcharge tier. Not great, but manageable. Now one partner passes. The survivor still has more of that income. The pension keeps paying. The RMDs keep coming. So say they have $180,000 of modified adjusted gross income on their own. Against single brackets, that could push them into a much higher IRMAA tier than the couple ever faced together. The surcharge per person could go from $1,148 to $4,600. Same house, similar income, much bigger Medicare bill. The RMD didn't change, the investments didn't change, the tax bracket changed from married filing jointly to single. That's it. That's why this is sometimes called the widow's tax, because it's almost invisible to them, and it arrives in the worst possible year, or one of the worst possible years of that person's lifetime. And frankly, this is one of the things that viewers, if they understood it earlier, could make arrangements for and plan for. Even if it never happened, it's still good to plan for the unlikely event. The moves I'm going to show you next will show you how to shrink this charge. And by the way, the point of raising this now isn't to worry you. It's actually to take worry away from you, because the odds are probably in your favor, but you just want to feel prepared. And that's what the next section is all about. First, convert to Roth before age 63. Let me explain. A Roth conversion means moving money from your traditional IRA into a Roth IRA. You pay the income tax on it the year that you convert, but after that the money grows tax-free, and Roth IRAs have no required minimum distribution for the original owner. This gives you two wins at one time. The first win: every dollar you move out of the traditional account is a dollar that won't be in a future RMD. Smaller balance, smaller RMD, lower MAGI, modified adjusted gross income, at age 73. Second, when you take the money from your Roth later, it doesn't count towards your modified adjusted gross income, and because it doesn't count towards your modified adjusted gross income, you don't pay tax on it, obviously. That's the nature of a Roth, but you also don't pay an IRMAA surcharge on it. Now the hidden deadline. Remember that Medicare uses your income from 2 years prior. So anything you earn at age 63 and beyond, for most people, if they start Medicare at age 65, could count towards an IRMAA surcharge if the number is large enough. A Roth conversion is income in the year that you convert. So if you convert at age 64, it becomes income for Medicare calculations at age 66. But if you convert before age 63, that income lands in the years before Medicare. Gang, speaking of Roth conversions, on this channel we have 3 affiliate relationships. One is Bolden Personal Financial Planning Software. That's the personal financial planning software that I personally use. Bolden has a wonderful Roth conversion feature that allows you to do a lot of what-if calculations. And frankly, I've done it myself. It works really well. It also allows you to plan your finances in a way that spreadsheets just can't, because spreadsheets have cells, and in those cells you can make a mistake, and that could make a mistake throughout the entire spreadsheet. And spreadsheets don't normally link together, at least not well. But with Bolden, it's all right there. The best part is that they're offering 2 weeks free of their full-featured software. If this is of interest to you, you can use our affiliate code. Go to go.bolden.com/Schmidt, and you can use their full-featured software free for 2 weeks. After that, it's just $12 a month if you decide to keep it. The sweet spot a lot of planners aim for is in your late 50s and early 60s before you reach age 63. I want to be fair, because for a lot of people this isn't free. You're just paying tax now to avoid a bigger problem later. Whether that math works depends on your bracket today versus your expected bracket at 73, your account balances, and how long the money has to grow. This is the part that you don't want to eyeball. You want to convert just the right amount so that you fill up the tax bracket and nothing more. So model it out before you make the conversion. And by the way, done right, this is the single biggest lever to reduce future RMDs and, by extension, to reduce Medicare surcharges. There's also another lever, and it's for anybody that has charitable aspirations. It's called a Qualified Charitable Distribution, or QCD, and it's available starting at age 70 and a half. Once you reach this age, you can direct your IRA to send money straight to a charity. Here's why it's special. That gift counts towards your RMD for the year, but it never lands in your adjusted gross income. It satisfies the RMD requirement without ever raising the income that's used to calculate your IRMAA charge. But you need to do it in the right way. Let me compare the right way with the wrong way, because the wrong way, you're going to have a lot of problems. If you take your RMD and then write a check to charity, the RMD already hits your income. The damage is done. But if the money goes directly from the IRA to the charity as a qualified charitable distribution, it skips your income entirely. The 2026 limit, by the way, is generous. It's $111,000 per person. For a married couple where each spouse has their own IRA, that's $222,000. A few rules to keep it clean. It has to go directly from your IRA to a qualifying 501c3 charity. It can't go through your checking account first, and it can't go to a donor-advised fund or a private foundation. So if you're already contributing to charity anyway, this is probably the move. You're going to make the gift regardless, so routing it through as a qualified charitable distribution has a lot of benefit. And the charity that receives the gift, they don't pay tax on it either. So nobody pays tax on a qualified charitable distribution. You paid no tax on the money going in, and it comes out and arrives at the charity without any tax being owed on that amount. Now, what happens if you discover this too late and you already received the IRMAA surcharge? Well, all is not lost. You can appeal the surcharge using Form SSA-44. Form SSA-44 is the form you file when your income is dropped because of a life-changing event, and the 2-year-old tax return Medicare is using no longer reflects your real situation. But it's important to note here in all those situations that you have to appeal it, they have to approve it, and it's only good for 1 year. Meaning if you had income like that again in the following year, well, in that situation, you can't appeal it again. But appealing it works out well for a lot of real life situations. Picture someone who earned a strong salary in 2024, then retired in 2025. Their income fell, but Medicare is still pricing them off of that 2024 paycheck. With Form SSA-44, you're asking Social Security to use your current income, not the income from 2024. You explain the event, you provide proof, a retirement letter or something like that, and you file the form. It also ties back to the widow's tax we covered. The death of a spouse is a qualifying life-changing event if the survivor's income actually dropped as a result. Form SSA-44 may let Medicare use that lower income and reduce the surcharge. The takeaway from all of this is that the RMD is the trigger and the Medicare surcharge is the second event, often unexpected. And you have real options before and after it lands. So here's the plan in plain English. Your required minimum distribution at 73 isn't only a tax bill. Because it raises your income, it can lift your Medicare premium about 2 years later through IRMAA. The numbers are real. The surcharge starts at $109,000 for someone who's single and $218,000 for someone who files jointly. It works like a cliff, and someone who's $1 over the limit is pushed into the next bracket, and they pay the entire surcharge for that bracket. Speaking of brackets, the surviving spouse is put into the single bracket in the following year, which raises their tax bracket, even if they don't feel a difference in the lifestyle. Even if their lifestyle has gone down a little bit, they could be paying more tax because they're single. The important thing to remember here is that the RMD is mandatory. The Medicare surprise often is not. If you like this video, check out that video. Most retirees don't know that this Roth conversion window closes after 2028. Also, don't forget to check out Bolden to try your 2 weeks for free. Go to go.bolden.com/Schmidt, and you can try it for free for 2 weeks. If you like it, it's just $12 a month after that, paid annually. This is Jeff Schmidt, and I will see you in that video right there.